multifamily cap rates, mortgage rates, inflation, everything in the economy will be affected. And this webinar is going to touch on all of these aspects. And throughout the webinar, I'm going to present data from dozens of different sources about how the interest rates and inflation are affecting real estate every single day. And in the end, I'm going to stick my neck out. I'm going to make 12-month predictions on both prices and rates. And I'm going to point out all the areas where I disagree with the experts out there. I obsess over these predictions because many of you are going to screenshot that last slide and throw it in my face a year from now. But, hey, thanks for doing that because it makes me a much more careful forecaster. Now, for those of you who don't know me, I'm very quirky, I'm opinionated, I'm a data scientist, I'm a technologist, and I buy and build large projects, 30 properties, 10 states, roughly $1 billion. But what I really like the most is doing what I'm doing now, teach, explode myths. It's a lot of fun for me to be doing these kinds of events. Why am I qualified to do a webinar on interest rates? Well, I mean, this is a sampling of my portfolio, about a third of it. This is about $400 million. And I worry about the impact of interest rates on the cash flow and the sale price of all of these projects every day. Every day I think about how to minimize that impact. So I think that's qualification enough. On the left in green, past and present multifamily value adds. We've been exiting them at 20 to 50% annualized. In orange on the top right, new construction apartment complexes that either are being built now or have already been built. And then in blue, diversification projects that our investors wanted, like self-storage and industrial warehouses. Other half of our portfolio is a new asset class called build to rent. So if you do not know what is build to rent today, it's the same as not knowing Bitcoin in 2010. Simply put, BTR is the new Class A apartment complex. It's the largest, the most powerful, and the most profitable opportunity that exists in real estate today. Here's our track record. As you can see, 7 exits. We've delivered more than double the returns that we projected to investors years and years ago. And track record is critical, but what's more important is that our 820 investors like us and they like our work. For example, Sarah, she's invested in 8 deals. She's had 3 terrific exits. She's also invested in new construction projects that are expected now to outperform. So she talks about how we outperform our other syndicates and how we look for better ways to do things. Chong's an investor in 10 projects with us, and she talks about an exit where we went the extra mile by building an additional 29 units to juice the returns. All right, done with the rah-rah portion, thump my chest, blah, 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 content time. But before we get to content, here's the really boring stuff that my lawyer forces on you. This is an educational webinar. It doesn't squeeze out the risk in real estate investing. My recommendations are not magic, they're opinions. Do your own due diligence, consult professionals, and understand that even if you do all of these things, you could still lose money. Bottom line, stocks, real estate are risk investments. And definitely feel free to type in your questions. I'll be happy to take them at the end. And we'll also be doing a recording of this. All right, take a look at this. My design team really knows how to get the message across. 8.5% inflation in a country where the average inflation has been under 2%. Julius, I filled my gas in my car yesterday, and $100 bill didn't fill up my 16-gallon tank. Right? How crazy is that? I mean, and so my first section, Julius, in this presentation is going to talk about this runaway inflation, the interest rates, and the Fed's dangerous gambit. So get ready for some powerful data. I'm going to start this journey by looking at mortgage rates first. Let's look at this CNBC video. It's from May, but it's a little outdated, 6 weeks outdated, but I think the content is still very strong. Before I play the video, remember this: the Federal Reserve does not set mortgage rates. They only influence them. Here we go.
Hey, Morgan. Yeah, rates took a sizable jump higher at the end of last week, basically adding insult to injury in the heart of the spring market. The average on the 30-year fixed hit 5.64% on Friday. That's just over 2.5 full percentage points higher than a year ago, as in we were in the very low 3% range last year. Mortgage rates loosely follow the yield on the 10-year Treasury, which spiked to over 3%. But rates are also taking a hit from the Fed unloading its balance sheet of mortgage-backed bonds. It was the Fed's increased purchasing of those bonds during the first 2 years of the pandemic that kept rates hitting more than a dozen record low. And those low rates fueled the crazy high home prices that we now have this spring. Home prices are 34% higher than the start of the pandemic,
34.
and they just keep moving up due to high demand and still low supply. So if the 30-year fixed hits 5.75%, which it very well could this week, that'll mean the monthly mortgage payment for the average home is $1,867 higher than it was at the start of the pandemic. $1,867. That's if you're putting 20% down. It would be over $2,000 more a month if you can only put 10% down, which is a lot of first-time buyers using FHA mortgages, and they, of course, have the least wiggle room in their wallets. We're now seeing sales fall, and reports anecdotally that bidding wars are starting to cool off. Prices usually lag sales by about 6 months, so this summer should be pretty telling on home prices, Morgan.
So let's quickly summarize this video, right? So in May 2021, right, mortgage rates were at 2.98%. And in May 2022, when this video was made, 5.64%. Now, I checked them yesterday, and they've dropped a little bit, but they're still at 5.4%. So that means they're up 2.5% higher than a year ago. And we also saw that home prices are 34% higher than before the start of the pandemic. That means that the average monthly payment is over $1,800 a month higher than the start of the pandemic. Are you kidding me? $1,800 a month? That's $22,000 a year. What average Joe American got a $22,000 raise in only 2 years? Nobody, right? So that's the bad news. But I'd like to point out that the media actually loves to pick up the highest number to get more eyeballs. So that 5.64 number on the screen is actually not representative of all the investors. So I sent my team out last week to shop rates on the internet, and I know my investors can put 20% down. They've got strong credit scores. So while 5.64% may be the average mortgage rate, please note that those buyers that have higher credit scores and higher down payments than a typical buyer will get significantly lower rates. And this data is from bankrate.com. As you can see, the rates that are shown in this gray shaded column on the left, they're in the 4.9% range for those with 20% down and 740 credit. Now, these numbers are for primary homes. They're not for investment homes or multifamily. But what this means is that people with lower down payments and lower credit scores, they're the ones that are going to hurt more. Richer investors who have more buying powers are still getting rates on properties under 5%. So bad news for the common man, less bad for the most affluent investors that have more money. So if you put 20 or 25% payment, you'll get a better deal. Still, it's clear that mortgage rates are skyrocketing. A 2.5% increase in 6 months is a stunning increase. So let's spend a few minutes to understand why rates are skyrocketing. In short, they're going up because the Federal Reserve has announced they're going to fight inflation by raising the Fed funds rate. Let's take a look at where inflation is today. As you can see, from the red horizontal line in the graph, inflation in the US tends to average just a little bit under 2%, and the Federal Reserve's job is to keep it around that number. 2% inflation allows the US to keep overspending, keep running up deficit, because inflation is a hidden tax. It reduces the value of money. So inflation is good for spenders, bad for savers. Now, high inflation is good for nobody. It's bad for consumers, bad for businesses, bad for us, bad for retirees. And as you can see from the chart, inflation is far, far above that 2% line. Now, it's wrong to look at inflation statistics without acknowledging that the official measure of inflation, the Consumer Price Index or CPI, is inherently flawed. The numbers may be cooked, guys. The CPI is used to adjust Social Security payment for retirees, and there have been accusations for decades that the CPI is manipulated to show inflation to be lower than it actually is. So it's also useful to look at an unofficial index called shadow stats, which might show a more complete picture. As you can see from the blue line above, real inflation in the US could be as high as 12%, while the official line in red is at 8%. Bottom line, inflation is out of control, and the Federal Reserve, they've got no choice but to take aggressive action to reduce inflation. Let me just say this again. The Fed has no choice. Now, the Fed can control inflation by raising and lowering an internal rate that they call the Fed funds rate. And this rate, which is a rate that banks charge each other for their excess reserves, it has a direct impact on mortgage rates. The mortgage rates can often be out of sync with the Fed funds rate for many months. In general, the Federal Reserve raises rates when inflation is high and the economy is overheating, and then drops them when the economy is weak. For example, if you look carefully at this chart, you'll see that the Fed raised interest rates 9 times between 2015 and 2018. And by doing that, it slowed the economy quite a bit. Then the Fed was forced to back off and drop the rates 3 times in 2019. What I'm pointing out is that this rate raising business is more art than science. The Fed raises rates, waits for a while, studies the economy, then drops them, waits for a while, rinse repeat. The Fed basically plays Russian roulette with the US economy. And as you can see from this comment in the Guardian or in the Economists, the Fed is now expected to raise rates a total of 7 times this year. And they're done with 3 hikes. So 4 more hikes coming, which should take the Fed funds rate from about 0.25% to about 2.9%. And what's the Fed's goal in doing this? To engineer a soft landing. Soft landing. More about that in a couple slides. And so the Fed's raised 3 times this year a total of 1.5%. But you just heard from the CNBC announcer that mortgage rates are up by 2.5%. So that's really weird, right? Aren't these two rates tied to each other? Yes, but very, very loosely. What's happening is that the market is anticipating what the Fed will do, and they've raised their rates by almost 2.5%, right? And so they're running roughly 3 hikes ahead of the Fed. This is very important to understand. The market's already up 2.5%, the Fed's only up 1.5%. So the Fed actually has to catch up to the mortgage market. Yes, yes, but Neal, what happens when the Fed hits the 2.9% level that economist was talking about a few slides ago? Well, the answer is that then the Fed will start cutting rates. Yes, cutting rates. Take a look at this chart very carefully. Look at every peak. The Fed controls inflation literally by gut punching the US economy. They taser us. And the country can't take the shock of those high interest rates for more than a few months. Look at this chart and you'll see that of those 9 hiking cycles since 1961, all of those 9 peaks on the screen are extremely short. In fact, those peaks usually don't even last more than a few months. Given how addicted the economy is to financial cocaine, low interest rates, and financial meth, ultra high liquidity, why would you expect this time to be any different? The patient, that's us, the US economy, is going to die if it doesn't go back onto this drug drip. And the Fed, they know that. Rates will peak by the end of this year or before. Inflation will hopefully moderate to, let's say, 3%. And then rates will fall, just like they have 9 times before in the last 61 years. Because the Fed is not trying to kill us, they're simply trying to engineer a soft landing. And as you can see from this Investopedia definition, a soft landing is the Fed's goal to slow the economy down without it going into a severe downturn or a recession. Choke the air from the lungs so the patient stops running around and then resuscitate the patient before he dies. This technically, highly technical diagram on the left accurately describes what the Fed is trying to do. So of course, a data-driven audience like Julius's wants to know, Neal, how often has the Fed really soft landed the plane? Well, as you can see from this quote from Politico, the Fed, it sucks at creating soft landings. In the last 61 years, the Fed has tried to engineer soft landings a total of 9 times. How many times did they succeed? Once. One time in 1984. Not the best track record. Why? Well, because it takes many, many, many months for the interest rate hikes to affect the economy. So the Fed has to make educated guesses about the impact. In other words, the Fed cannot aim, fire, measure. It's more like aim, fire half a dozen times, then measure once. So here's another highly technical document that accurately describes what the Fed tries to do when it hikes interest rates. As you can see, my team loves these cartoons. Clearly, they're getting carried away, Julius. And so that technical document explains our big problem. And it also explains why the stock market is crashing. Investors feel that the Fed's job is much harder to this time than the last 9 times because inflation is so severe. And so they have very, very little interest in the Fed's ability to prevent a recession. The market's addicted to these ultra low interest rates, this high liquidity punch bowl, and the Fed's taking the punch bowl away. Now, in case you're wondering, On the screen, you see S&P 500, you see NASDAQ down, whatever, 32%. You're wondering, what about real estate investment trusts? Well, they're also down about the same as the S&P 500, about 20% for the year. Okay, so the Fed doesn't have a great track record and Wall Street doesn't trust the Fed. But to be fair to the Fed, they might have a pretty decent chance of actually achieving a soft landing this time because this Fed has one unique weapon. The Fed is tightening in an economy that is drowning in cash. Americans have absolutely fantastic household savings. As you can see from the graphic above, the total value of America's savings in both savings and money market accounts was about 12 trillion 10 years ago. In 2011, here on the left. Today, that number is sitting pretty at over 22 trillion. In fact, a staggering 5.8 trillion has been added to savings account in just the last 2 years. And this is incredibly good news for the Fed because this $6 trillion buffer, this cushion, means that consumers are continuing to spend even as inflation goes up. They have a lot of money. And this gives the Fed a better chance of engineering that soft landing. And now that I'm done with my Fed bashing, I do want to point something out. That 5.5% that we're at right now, it may seem high. Note that people were buying homes at 18% interest rates in 1982. Look at this graph. And you see this gray area here in 1982? As you can imagine, that was a US recession caused by the Fed raising interest rates to 18% to kill inflation. I wonder what happened to home prices when the Fed raised interest rates to 18%. By comparison, we're predicting that rates will go up to less than 6% at peak today. Now, you might think that home prices would have crashed and burned in 1982, right? I mean, who'd be stupid enough to buy a home with 18% interest, right? Wrong. When the Fed went to 18%, home prices actually went up, right? But went down by 10% the next quarter, then bounced back by 10% the following quarter, and actually ended up higher at the end of the recession, this gray section here, than it was at the beginning. Bottom line, Americans love buying homes, and they're not easily deterred. And that was one example. Let's look at another example. Even between 2001 and 2007, rates stayed between 5 and 7.5%, and we had a strong housing economy. So while 5.5% seems high, it's really nothing special at all. I also like to show this graph to investors. This graph isn't updated to 2022, but what I want to point out is that the mortgage rate trend in the US declined for a straight 150 years, then went upwards for about 15 years and 20 years until it peaked in 1981, and since then for 4 decades they've been moving in a downward direction. And when this short-term mortgage rate spike ends, and it should end fairly quickly, I do not expect that downward trend to change. It's all tied back to macroeconomics, which I've actually covered extensively in a webinar called How Banking Changed the World. It's available on my website, multifamilyu.com, in case you're interested. All right, so summarize this section. Rates are high because the Fed's battling inflation. Data indicates that mortgage rates will actually peak before the end of the year as mortgage rates anticipate future Fed increases. And while we hope that the Fed engineers a soft landing, history shows that this is unlikely to happen. Now that we've set the groundwork, let's go to section 2, where we discuss if the US housing boom is in a bubble. Julius, I love this graphic. Isn't that an amazing graphic? Housing in a bubble? Haha. Right? Figuring out if this is a bubble, I think is critical, right? Because we're all here to try and figure out what's going to happen to real estate in the next year. And what happens depends on whether housing is indeed in a bubble. That drives all of our informed speculation. And my first data point comes from Fortune magazine and CoreLogic. Now, as you can see, CoreLogic believes that 65% of US housing markets are overvalued. And every single major growth market, Texas, Florida, Arizona, North Carolina, Utah, all of them are overvalued. So 2/3 of the country is overvalued real estate, and 100% of growth markets are overvalued. Are you getting nervous yet? Well, you shouldn't be nervous because here's the same company's estimate of price drops. Remember in the first slide, they were talking about overvalue, not price drops. Here you notice not much red. Blue is good. Blue's really good. CoreLogic estimates that 80% of the US has low or extremely low chance of price drops. 10% of the US is about medium risk, mostly here on the right, in purple in the Northeast, and also in the Pacific Northwest and in California. All the growth markets in Texas, Florida, Utah, North Carolina, they're all blue except for one, the Phoenix, Las Vegas market, right? And the high risk markets that have very elevated risk of price drops, they're all in the Pacific Northwest, like Bend, Oregon, or Tacoma, Washington. Bottom line, I have done the job for you. I've looked through a lot of research papers. All of these people remember 2008, so they're much more cautious, but there is a very strong consensus in the market that housing is not in a bubble. But why is it not a bubble if it's overvalued? Why? Well, all of the studies cite the lack of supply from both single family and apartments. There's a severe lack of zoned land, supply chain constraints, rising cost of construction, and a very NIMBY attitude towards new apartments. These four main reasons are causing a lack of supply. Now contrast that with 2007 where there was plenty of supply. Now match up this lack of supply with very strong demand from boomer investors and from millennial homeowners, very strong job markets. We are under 4% in the unemployment rate. And it's very hard for this housing bubble to burst, even if it exists. So, as we've mentioned before, that massive stimulus from COVID means that both investors and the common man have a massive amount of accumulated savings in the bank. So, if there's a dip in prices, investors jump in. Incomes are rising very fast because of inflation. And lastly, this crazy remote work phenomenon means that Americans are spending more time, more money on their homes. They want offices, they want more rooms, and that's driving demand up even as rates are going up. So these are big, big reasons that lead us to the conclusion that the US single family market is overvalued, but it's not in a bubble. Now, as we looked at studies and analysis from various sources, including Forbes and the Wharton Business School, we couldn't find one analyst that felt that housing was a bubble that could burst. Even bearish analysts like Ivy Zellman, they take pains to clarify that housing is overvalued, but is not a bubble. And you can see some of the reasons why housing is not considered to be in a bubble. And what if everyone's wrong and there is a bubble? Wouldn't interest rate hikes pop that bubble if sales tank? The answer is they probably won't because of ARMs. ARMs, adjustable rate mortgages, are back. In January, only 3% of single family loans had an adjustable rate. But by May, that 3% had tripled to 9%. Currently, the average rates for a 5-year ARM, shown here in orange, is nearly a full point lower, right? And that allows buyers to continue buying and keep the down payment down. So I wouldn't be surprised to see ARMs become 20% or even 25% of all mortgages within the next 3 months. And I know, ARMs are bad. We didn't learn from 2008, yada, yada, et cetera, et cetera. But if those ARMs are going to blow up, they're going to blow up 5 years from today. And rates don't adjust for the next 5 years. So I'm not holding my breath, and neither should you. So the US market is probably not in a bubble that's going to pop. So what's actually going to happen? Well, instead of sharing information from a half a dozen different analysts, I'm just throwing up the least bullish guy, the bear, right? Everyone else thinks that the market will slow down but keep growing, prices will keep going up. This dude on the screen, he's the only guy that says, nah, not going up. So the most bearish guy says, and you can see here in blue, everything points to a rolling over of the housing market. Well, that comment looks like gloom and doom, but then you jump into the dude's detailed analysis, and what he's really saying is home prices will be flat. And then look at the two green bullets. Some markets drop by 5 to 10%, and if there's a recession, they drop by 10 to 20%. Still, he's talking about some markets, not the US. And this is the most bearish analyst that I could find. All right. So the single family market is probably not a bubble, just overvalued. What about commercial, right? You know, multifamily, industrial, retail, all the other asset classes. Well, here's John Chang. He's a personal friend of mine. He's the national director of research at Marcus and Millichap. This is John's 26th year at Marcus and Millichap. So I think he knows a few things. Let's hear from the man. Now, note that John's going to talk about cap rates, but you can actually swap the word bubble in for cap rates pretty safely. Very similar analysis. Here we go.
Hey everyone. The top question I'm being asked these days is when or whether cap rates will rise due to increasing interest rates. Many investors
Can we
think
mute
there's
Lamar?
a direct correlation between cap rates and interest rates, that borrowing costs will drive investor purchase decisions, and because of that, sellers need to lower prices and raise cap rates on the properties they sell in order to clear the market. While there's some merit to that idea, it doesn't completely hold true. Looking at commercial real estate in general, the spread between the average cap rate and the 10-year treasury has ranged from as high as 582 basis points in 2011 to as low as 214 basis points in 2006. There's simply a lot more going on in commercial real estate than underwriting to a spread over the cost of capital. Here are a few of the other considerations and how they're impacting yields today. First, how much capital is active in the market? Sometimes there's a shortage of capital, like during and immediately after the financial crisis. When there's a shortage of capital, cap rates tend to rise and the yield spread tends to widen. But when there's a lot of capital, both equity and debt, the spreads tend to tighten. We're going through that process right now. Last year, there were a record number of commercial real estate sales. The total number of transactions was up about 30% compared to 2019, which was the strongest prior record. Preliminary estimates of first quarter activity this year suggest the rapid transaction pace has continued, with sales up approximately 20% compared to the first quarter of last year. Basically, when there's a lot of liquidity, investors are willing to take a lower yield because they're competing to invest capital. A second factor is whether there are alternative investments that offer a better yield, maybe the stock market or bonds. Given that the S&P 500 has fallen more than 16% since peaking at the end of 2021,
22%
more capital
now.
may pursue the stable returns offered by commercial real estate. That in turn increases buy-side pressure, keeping cap rates lower. A third factor is upside potential, either through market momentum and strengthening fundamentals or through investor value add. For example, industrial property absorption has averaged nearly 300 million square feet per year for the last 10 years. And it surged to 550 million square feet last year, driving the vacancy rate to an all-time low and boosting rent growth. Given the exceptional momentum, investors remain aggressive in their industrial acquisitions, keeping pressure on cap rates. Likewise, investors continue to pursue value-add real estate, paying a premium on existing revenues with the intention of raising returns over the next year or two. Finally, we need to consider demographics. As baby boomers retire, they're looking for reliable cash flow. And commercial real estate, especially single-tenant net lease properties, fits that role. Retiring investors leveraging 1031 exchanges are a significant driver in this arena. So even though interest rates have been rising, and many expect that trend to continue, it will not necessarily push cap rates higher. We may see some upward movement, most notably in markets and property types that appreciated fastest in the last year, but a broad-based re-indexing is unlikely.
And so there ends our second section. It does appear that neither single family nor commercial are in a bubble, just bubbly or bubblish. And now it's time for the crystal ball section. This is where I stick my neck out. And you, smart Alex, you take screenshots and then you use it to cut my neck off a year later. So here we go again. I'm going to make 7 predictions. 1 year from today, where will single family prices be? Multifamily, inflation, interest rates, cap rates. And we're going to wrap up that crystal ball section in this webinar with our prediction on the likelihood of a US recession. But before I fire up the crystal ball, I want to take a few minutes out from this content to share 2 of my projects that I think are very attractive in today's interest rate environment to both active and to passive investors. The first one, it's a unique project. It's in the Austin market, which is the hottest in the country. We're building a technology-enabled micro home community located in San Marcos. So it's filling a sorely needed gap in an area with a severe housing crisis. We've already raised $11 million for the project, so it's 90% subscribed. This model, we call it Casada. It's got 3 major elements. It's got a stunning yet very efficient, modern, environmentally sensitive design. It's got an incredible tech stack of 14 different technologies that are conveniently combined into a proprietary mobile applications that allows residents to manage all their needs and also control their smart home. And lastly, it has a curated lifestyle with cultivated engagement opportunities that tenants really crave. So all Casada units are modularly designed and constructed off-site. This is a construction method that's incredibly popular in Europe. Allows for faster construction, less waste, higher quality structure, and reduces the development's initial and also the long-term operational costs. So what that means for investors, better returns, much faster cash flow. As you know, when it comes to multifamily investing, Austin is the place to be. Let's take a look at Austin stats. In the past 10 years, the population of Austin grew by 32%, 6 times faster than the US. But that didn't even keep pace with job growth because it grew by 44%. Austin's quickly becoming the new Silicon Valley. It's got the hottest city labor market, which is leading to skyrocketing real estate prices. According to Redfin, rents increased a whopping 35% last year. And when our first Casada branded community in Austin started pre-leasing last year, we had to raise rents 4 times. So we highly encourage you to attend a group session with one of our people where he can tell you more about the project. Our second project is Equinox Townhomes. These are duplexes in New Braunfels. They're also in Texas on the Austin-San Antonio corridor. Phase one was completely sold out, but we've had a couple investors that backed out because of the stock market losses. So we have a couple duplexes available again. This is a beautiful 110 townhome community. It's spread over 10 acres. It's right in the middle of the city. There's a retail center on the right, and the city is building a large modern park on the left. It's got vaulted ceilings, got large windows, wide rooms. It's a dream product for both renters and for investor buyers. We're projecting investors will make 27.9% annualized, and they will get 100% ownership of a turnkey duplex. You've all heard that build-to-rent homes are by far the fastest and hottest growing section in all of real estate. So if you combine that BTR trend with the third fastest growing city in the US in terms of population, you end up with what we think is a home run project. And New Braunfels is an amazing city. Population growth is even faster than Austin, 10x faster than the US. Job growth, 9.8x faster than the US. Incomes rose a crazy 26% in 1 year in 2020. That flooded the city with lots of new affluent buyers and tenants. Amazing numbers. We also created a interest rate cap program. So we cap your interest rate so you can invest in our projects without worrying about a future interest rate increase. This unique program is only available through us. So if you're interested about these two projects and our new interest rate protection program, please book a group call. The two links for the projects are on the screen, and I'll also paste them in the chat for you. All right, shameless self-promotion is done. Let's finish the webinar with the crystal ball. We're going to give you our informed projections on all of these topics. How many times will the Fed hike? What will interest rates be like 12 months from now? Will inflation be raging 12 months from now? And will home prices be higher or will they be lower? Will syndicators be paying more or less for multifamily prices? Will the US economy be in a recession 12 months from now? And finally, what will multifamily cap rates look like in a year? So these are our projections on what I think is a very bumpy ride to come. My first forecast is on Fed hikes. As of today, the market is robust enough. So yes, the Fed will actually do what it's been telling us they will do. They will hike the rate from 1.5 today to 2.75% by the end of this year. So a lot more hikes coming, with 2 of them coming just in the next 2 months. So very painful for those of us with bridge loans with floating rates. I know many of you think that the economy will weaken so quickly that the Fed will not get to all of its hikes. But to those people, I say this: the only thing worse than drinking Kool-Aid is to smoke opium. They will go through the hikes. That's my prediction. The Fed is terrified of hyperinflation, and the Democrats are even more terrified of it because of midterm elections. It's going to happen. All right, let's start with my interest rate forecast. On the left are single family interest rates or mortgage rates. And this is going to surprise you. The video at the beginning of this presentation said that single family mortgage rates were at 5.5% already. So 6.25% or lower is really gutsy, right? With so many Fed hikes to come. No, it's not gutsy. Most forecasters actually agree with me. If you look at the blue bars in the chart on the right, and you take out the first guy Adamo and the last guy Helios, the outliers, then the consensus is actually around 6%. So my number is actually a little bit on the bearish side. Remember, the market's already priced in future rate hikes. So I think this one is fairly safe. So I think interest rates for single family, 6.25%. Multifamily, around 6%. I predict that 10-year fixed rates will stabilize around, 2.9%. So multifamily rates should be around 6% a year from now. Bridge rates might be a tad bit higher, but not a lot higher. All right, done with rates, on to home prices. My single family prediction is that prices will not drop nationwide. They will go up by 4% in the next 12 months. But this price hike, it will not be across the board. I do predict that ultra hot markets such as Tacoma and Boise will see price drops by almost 5 to 15%. In fact, I agree with every city on this slide. Redfin and CoreLogic came up with a list of markets that are very likely to see price declines. Luckily, no major cities in this list. So if you're Californian, you might want to note that Sacramento's in the list. Washington State has 3 cities in the list. The rest are pretty small. So bottom line, 4% up nationwide, 5 to 15% drops for cities on this page, plus Boise. That's my single family price forecast for 12 months from now. All right, let's move over to multifamily and predict cap rates a year from now. Now, I know that there are people in the audience who don't understand cap rates fully, and even people who understand cap rates find it hard to calculate the impact on prices. Well, here's a simple example. Let's say that a property was selling in January before the war in that ultra hot market at 4 cap for 30 million bucks. Now, if that same property was selling now and closing in October at 4.5 cap, its price would drop by more than 10%. So it would be 26.3 million. So half a cap is a pretty big freaking deal. It can make the difference between investor making 30% a year or making 15% a year. And I'm going to predict that cap rates will rise. I disagree with my friend John Chang at Marcus and Millichap. I disagree with JLL. I disagree with the National Association of Realtors. They all expect that multifamily cap rates will stay where they are. They will plateau. I disagree. I predict that multifamily cap rates will rise by as much as 0.5% from their peak, which was probably Q4 of last year or Q1 of this year, right? Remember, when rates go up, cap rates go up, prices go down. Now, why am I disagreeing with fellow forecasters? Well, because while the past is a great predictor, and the past is definitely in favor of the big guys that are forecasting a plateau, we've never seen cap rates this low. And I believe that the lower cap rates go, the more sensitive they become to interest rates. All-time low rates equal all-time high sensitivity. Hence my prediction of 0.5 cap up. Now, note the comments on the right. I do believe that multifamily rates will only decompress for 3 or at the most 4 quarters, and then are going to compress again because of this massive hunger in the market for multifamily. So I'm content to hold on to my portfolio for the next 5 quarters and benefit from that hunger. All right, now let's look at the projection of multifamily prices 12 months from now. But wait a minute, Neal, didn't you just show us an example with prices going down from 30 million to 26 million and change? So didn't you already answer the question that's at the top of this page? No, I didn't. In the last slide, that was an example of how higher cap rates will depress prices. But there are actually 2 things that affect multifamily prices. One is cap rates, the other one is net operating income, or NOI, right? So now let's take a look at, you know, hang on. Let's take a look at our projection of multifamily prices 12 months from now, right? Let's tweak this example. I just gave it to you, right? On the left, there was a property it was selling in January at 4 cap for 30 million. On the right, the same property is now selling next year at a higher cap rate, 4.5 cap. But rents are going up like crazy, right? So if rents go up 10% in that intervening year, this property, even at higher cap rates, sells for almost the same price. So my multifamily price prediction is down, then back up. I expect that when we compare price per unit to Q4 of last year or Q1 of this year, the ultra hot phase, to prices in Q3 or Q4 of this year, the post hike phase, we will find that the price per door is 5 to 10% lower depending on the market. But as rents continue to rise, we should see that situation start to reverse. And 12 months from today, I absolutely wouldn't be surprised to see multifamily prices go back to where they were in Q1 this year. So down a bit, up a bit, but overall flat if you look out 12 months. All right, two final predictions left in this webinar: inflation and US recession. I project that the Federal Reserve will beat inflation. Look, they've done this 9 times since 1961, and with the exception of 1982, they've beaten inflation every time. And while inflation was 8.5% in May, that was a 12-month reading. I went to the St. Louis Fed website, I found the month over month inflation, and it's definitely moderating. Supply chain issues are also easing. Lumber prices have crashed from 1,300 to 650. So we do predict that inflation is going to be about 3% a year from now. Not quite back to the 2% level that the Fed loves, but well in control, enough for them to stop this gut punching. And we end this webinar by projecting a US recession within the next 12 months. And I differ from analysts. The consensus today is for a 40% chance for a recession within the next 12 months. I think that's recency bias. And that 40% number, it's going to keep going up as the Fed keeps throwing these rate punches, these liquidity uppercuts. My belief, there's a 80% chance of a US recession next year in 2023. So no recession this year. The economy's too strong. Balance sheets are too rich. It takes time to cool everything down. Note I'm not predicting a 2008 type recession. So in this chart, you're going to see 8 gray bars. 2 of those are thicker bars, which indicate longer recessions. And I believe the recession will be a typical vanilla 6-month recession. It's going to be accompanied by the Fed cutting rates and also increasing liquidity, starting this cycle all over again. So if you can hold on beyond that 2023 recession, you should be able to refinance your property at lower rates and also see strong demand for your assets as demand comes back into the marketplace. So with that positive news about future rate cuts a year from now, we end this webinar. I'd be happy to take your questions. Here are some links on the screen for those that are interested in my projects. Back to you, Julius.
Thank you so much, Neal. That was amazing, as usual. That was actually the second time I saw that talk, and still feels just as brand new as ever. So thanks for sharing those incredible insights with us. And certainly we will be looking forward to checking those predictions out and getting some feedback from you or to you about what happens 12 months from now. Yeah, so please, thank you. For everyone else, please start dropping your questions in the chat, and I will ask Neal. In the meantime, we did do a giveaway for folks that were going to attend this meetup, and there are 3 people who won the gifts for the giveaway. They are Lisa Jordan, William Chu, and Joshua Torres. So for those 3 people, congratulations. You will be winning a copy of the book, The Miracle Morning by Howard Edward, and an XSITE notebook, a pen, and a car accessory. So congrats again to Lisa Jordan, Will Chu, and Joshua Torres. Now back to talking with the guru himself. Ryan asks, in your inflation prediction, what about supply chain problems that are causing inflation issues that are not affected by the Fed's rate hikes?
Well, I'm a developer myself. As a bigger portion of my portfolio is development. A smaller portion is a value add. And so I look at this portion very carefully. So I'm not making this prediction trivially. So just so you know, we are beginning to see supply chain issues abate. I gave you the example of lumber. It's down to half the price. But more than that, we are now starting to see some discounts come into the marketplace. We also track to see how many ships are waiting outside Long Beach, which is kind of our bigger port, and that number has been going down each week, Ryan, for the last 3 or 4 months. That's good news because you do not want 50 of those ships waiting outside Long Beach because that's going to reduce the number of goods in the market and spike inflation and make supply chain worse. But those numbers are going down. So even with cities in China being shut down, the rest of the world is adapting and we're beginning to see supply chain issues ease. I think this is one of those two-step forward, one step back thing, Ryan. So I'm watching it very carefully, but it certainly is not as bad as it was 3 or 4 months ago.
That's fantastic to hear. Ali asked, fantastic outlook and event, Neal. What are your thoughts on the political risk of the next presidential election?
Well, I'm not a presidential analyst, but I mean, only a brave man would predict that the Democrats will do well in this coming election. I think that Republicans are going to both take back control of the House and potentially take back control of the Senate. But even if they take back control of the House itself, that basically makes the president a lame duck. And he unfortunately has already been a lame duck for the last 2 years simply because his own Democrat senators never vote on any of his bills. So I think that when it comes to real estate, we basically, and this is an unfortunate and sad thing that I'm about to say, we basically like governments that do nothing. And there's a very high chance that we are going to get a government that is going to do nothing for the next 2 years.
Thank you so much, Neal. Ava was asking, what are your thoughts on the BTR SFR portfolio development of 100 homes completed in 2 years? Could we ride through the recession and stabilize the asset in 24 months?
Yes, I mean, wow, I could have almost given you $20 to ask that question, Ava. That's exactly my approach. I think that the Fed is going to gut punch until December, and at some point next year, rates start to go down, and then that starts to create this positive cycle, which takes a while to get going. It doesn't immediately get going, so it takes a while. Um, and so I think that that is the right approach. At least that's my approach. So currently, as you can imagine, I've sold a bunch of properties that have made me a lot of money because of all these crazy price increases. Guess where my 1031 is going, Ava? 100% of my 1031 money is going into doing exactly what you're suggesting. Build to rent properties. And I'm usually building not 100 homes, I'm building like 70 or 80. I just find those to be easier. So I'm building 87 in Port Charlotte in Florida. I'm building 114 in Rogers, Arkansas, and I'm building two separate sets of 70 BTR homes and also a 70 80 unit apartment complex in Idaho Falls. So I'm really banking on the fact that right now is actually great for construction because construction prices, the construction interest rates don't affect your returns as much as value add do because with value add, once you locked in rate, you're stuck for a while, right? With construction, you're really only using that rate for 18 months. So your major interest rate is the one when the property is finished and it's leased up. So you've got, you know, 2.5 years before your real interest rate comes in. And that's what I'm really happy about. So Ava says
Fantastic.
we're building in Tucson. Well, you're building in a great market, so keep doing that.
Awesome. And
Wow.
Ozzy D was asking, are you concerned about the
Mhm.
diminishing savings for the average person due to inflation? And are your pro forma numbers based on the current average income levels of your tenants?
So savings and average income levels are two separate questions, Ozzy. You should not mix them together. So on the screen, let me show you. Look at the astonishing changes that we are seeing in the marketplace, right? So, um, $5.8 trillion have been added to Americans' bank accounts in the last 2 years, right? That's a shitload of cash. That's a lot of money. So at this point, When you say diminishing savings, the data clearly doesn't support what you're saying, right? Now, inflation is going to whittle away at this 6 trillion. So maybe your question should be more about what happens when this 6 trillion is gone. Well, it actually takes about 2 to 3 years to get rid of the $6 trillion in gifts that we provided to the US. So it's going to take a while. And then after that, yeah, I'll worry about it, but it's 2 or 3 years out.
That's fantastic. Christian was asking, Neal, could you please talk about rent growth versus wage growth delta and how that comes into play with affordability?
Oh, I love talking about this, Christian, because I think this is the one piece that I don't see anyone explain in podcasts or in webinars, right? So, Christian, a lot of people say, income, incomes are only going by 3% a year. Therefore, rent should only grow by 3%. That makes sense, right? I mean, for a sustainable increase, you would think that if incomes go up by 3%, rent should go up by 3%. That's completely false. And here's why. So let's say that Julius is making 60 grand a year. So he's a single person, he's making 60 grand a year. Okay. And now Julius receives a 4%, hike in his salary because, interest rates are high. So he gets 4% high. So basically now Julius's salary is basically gone from 60,000, right, to 62,400 because that's 4%, right? Now you might say, okay, so his rent should go up by 4%. No, I think Julius's rents can go up by 8%. And the answer is why? The question is that when you look at this 4% increase, right, only a portion of that increase was going into rents before. But what's happening today is almost 100% of all the new money that people are bringing in because their salaries are going up is going to only two places. It's going to rent and to food. One could argue that it's gas, but rent, food, gas is basically taking 100% of Julius's increases, therefore allowing Julius to sustain an 8% increase in rent even though his salary is only increasing by 4%. That's because Julius, even though his salary is going up, is not going to more movies, is not buying more stuff, is not doing more travel. So Americans are basically, unfortunately, being forced to put 100% of their rent, of their increases towards rent, which is the biggest piece, and then after that, food, and then after that, gas. This is bad for America, but it allows an 8% rent growth to be sustainable if incomes are growing by 4%. Think about that. No one ever thinks about this, but it's true.
Wow. Yeah. Thank you so much for that fantastic answer. William was asking, your comment about modular home construction, is this the new way to build new affordable single family housing?
We're not even close, William. So I am very disappointed by the US's lack of action on modular housing. So modular housing is very popular in Europe. In fact, 82% of all homes in Sweden are modular. They're built off-site. But currently in the US, less than 0.1% of modular homes are being built off-site. And the total factory capacity in the US, William, is so small that we can't even meet the needs of a small metro total. It's tiny. In fact, I'm currently building 1,500 units, and you might say, well, you like modular, so you must be building most of them through modular construction. No, only 210 of them, because there's no capacity in factories. I think in a just world, the US president or Congress would actually put $100 billion into building more modular factories, and we could actually, in 5 to 10 years, resolve our housing crisis. But nobody's doing that. Nobody's opening new factories. Now, you might think, your comment makes me think, William, that you think that modular is more affordable. Okay. How about you take a $100 bet with me? Nowhere in the United States is modular housing affordable. All modular housing prices today are higher than on-site construction. The only benefit today of modular is you can build faster. Until that changes, like in Sweden, modular housing is 20% cheaper. and is also faster. So they get both the cheaper and faster benefit. In the US, we're actually paying more money to get the speed benefit. And that has to change. And until it changes, modular is going to be just it's going to be a niche market that works in certain cases and certain projects and certain metros. In my case, it worked because the modular homes are being constructed at a factory that's pretty close to my development site in Austin. So my transportation costs were low, so that allowed it to work. But in general, if you look at most of my projects, I'm not doing modular because the math makes no sense whatsoever. And that sucks, by the way, because today, where we are with technology, we should be building everything offsite.
Wow, those are great insights. And with that, I think we may have time for just one more question. And that question will go to somebody from XSITE Capital is asking. I think that's Leslie saying, do you see the demand for apartments slowing down soon?
No, I don't. I think that the debacle, office used to be the single largest segment in commercial real estate, and the debacle in offices, this slow moving debacle of a remote work, is going to continue affecting them for the next 5 years, which is going to continue boosting apartment demand. I do not expect the demand to slow down. Again, as you saw from my presentation, you should see a decline in prices and then prices go back up. So I'm not predicting prices are going up. I'm predicting they're actually going to go down. Demand is not the same thing as price. So keep that in mind. I do not expect to see any change in demand. And I see this follow-up question. Why is modular construction more expensive in the US? Because any kind of factory construction requires scale. When Tesla was building 60,000 Tesla S's, their cost to build a car was astonishingly high. When they got to the point where they started building 1 million cars a year, that's when they've gotten to the point where they can have a car that's cheaper. So no one in the US has come even close to having scaled modular construction, which is why it's more expensive.
Wow, that's a great way to wrap this up, at least from the Neal's part. I really want to say thank you, an amazing thank you to Neal for gracing us with his presence. Once again, we have learned so much from you, Neal. And once again, congrats to the folks that won, Lisa, William, Chu, and Joseph Torres. You will get your gift very shortly. And certainly, you know where to find Neal if you need to invest in any of his projects. I think the information was displayed on the screen earlier. And if you need to get in contact with them, Multifamily U is always there, or you can reach out to us. We'll put you right in contact with them also. Excellent. Well, for the rest of you, please stick around. We will be networking for the next 25 or so minutes and getting to know each other. But thank you so much, Neal. You were amazing as usual. We look forward to the next time. Thank you.
Thanks, Julius. Have a good one. Bye-bye.
Appreciate it. Yeah, bye.
Bye, Neal.
Excellent. And for those that are sticking around, we look forward to chatting with you and getting to know you. Once again, I'm Dr. Julius O'Neill from XSITE Capital. And with me here today is Mr. Tenny Tolofari and Mr. Leslie Awesome and Mr. Braden Hyde. We will be chatting with you. We really want to get to know everyone. We see some old faces and some new ones. So if you are interested, please come on camera, introduce yourself, introduce your company, and share some of what you're doing in real estate or outside of real estate with us. We'll be more than happy to get to know you. Who is going to volunteer to go first?
I'll go first.
There you go. Fantastic, Ryan. Go for it.
Hey guys, Ryan Murphy here with the new partnership, Cashflow Champs, and partnering with Charles Seaman. I don't know if anybody here knows Charles Seaman. He does a Saturday session for underwriting every Saturday. So his name is getting well known. I wouldn't say my name's getting that well known, but maybe you'll know him. So, but anyway, so I'm in Seattle. He's in North Carolina, and we're in the Southeast markets. So.
Fantastic. Thanks, Ryan. It's so nice to meet you. We're also in the Southeast market and particularly the Carolinas. But we also looking in Georgia, certainly North Carolina, South Carolina. But yeah, it's very nice to meet you.
I think I ran into this through on a LinkedIn. I think it was Neal Bawa's. Somebody had posted something on it. So I don't know how to connect with you guys.
Oh, absolutely. We'll put that right in the chat for you.
Okay, great.
Absolutely, for sure.
Thanks.
Yeah. Thank you so much, Ryan. Who wants to go next? Ava had some fantastic questions. Ava, you want to say hello? She may be away from a computer. Anybody else interested in saying hello? Introducing their company, what they're doing. I think Ali is ready.
I'm ready.
Ava says she's not camera ready. Go for it.
It's all right. I'll take her place. Keep it warm for her. Hey, everyone. My name is Ali Samir, and I run a company called James River Housing Partners. And I control over 250 units representing 50 million in assets under management, with an additional 80 million in the pipeline now through development and acquisitions. We're primarily an acquisition and development shop, and in the Southeast, we're in 3 states and 4 cities now, and are expanding through smart acquisitions. And I share the same. First of all, I love the weekly underwriting warriors that you all, through Leslie, have put on. It's fantastic, and I try to attend every opportunity I can. And I love this. So thanks to you all for putting it together. I thoroughly enjoy the economics-based approach to real estate investing. That's very core to my ethos as well. So it's always great to connect, and thank you all for putting on such a great event.
Thank you, Ali. Really appreciate you. And congrats on all your successes so far. And for that incredible amount that you have in the pipeline. I think that's going to be fantastic when those come to fruition. So
if you're in the DC area, Ali hosts an amazing networking event here in DC. So make sure you check him out on Instagram. It's DC_CRE. I do plan on attending, so maybe we could have a drink over there someday. And just to add to what Ali said, XSITE Capital, we provide a lot of education, and one of those educational events is Tuesday underwriting class, which is every Tuesday evening at 8 p.m. If you're interested in learning more on how to underwrite these properties or to evaluate these deals to make sure that it's the right deal for your portfolio, you're welcome to join us.
Absolutely. Yeah, anybody else wants to chime in, introduce themselves, or even comment on what they just heard from Neal Bawa? Awesome. Well, I'm not gonna put anybody on the spot at all. Tenny, what are your thoughts about the?
Man, just continue to buy apartments, man. That's all I heard.
That's what I heard too.
It's kind of an interesting time, right? That's one of the things I like about Neal is because he brings the data perspective of things, because we hear a lot of stuff on the news that gets us scared. So but he gives you the numbers that could help you make the right decision. So I thought it was a great presentation.
That's fantastic. Yeah. Certainly a great presentation, no questions about it. A lot of familiar faces. Forrest is on, who is part of our team at XSITE Capital. Marshall, who is a fantastic. Oh wow, it's in his gear. Hey Forrest, how are you? How's it going?
Doing all right, Julius.
I see you're pretty busy over there.
Yeah. Awesome host today. Appreciate you guys hosting that.
Yeah, thank you so much. I mean, Neal brings it and brings the data. And Lisa was saying that great information, numbers matter. That's absolutely true. No questions about it. I see Jay Miller. I see Karen Anderson. Good to see you all. At least see your avatars, even if or your names. Not if I'm not seeing your faces. Yeah, see Elena, Keith. These are all fantastic people that have been joining us for a while, and we really appreciate you all. Abubakar,
Yeah.
please introduce yourself.
Yeah, my name is Abubakar. I am the owner of 50X Development, a small boutique real estate company based out here in Buffalo, New York, and pretty much just getting to learn the ropes.
That is fantastic. Thanks for introducing yourself. I love the name of your company, 50X Development. Maybe in 2 years it will be like 150X Development. Yeah. So,
yeah, hopefully.
That is awesome, man. That's great. That's a great name.
And
I was
Julius,
the Buffalo. Yep.
I wanted to chime in real quick. Now we have a lot of you on here. What are your feedback? What session would you like to see in some of our next meetup events? What would interest a lot of you all to what would you like to listen to, basically, so that we can bring an industry expert like Neal to come and share insights to everybody and continue to educate this community. If anybody's have an opinion, we would love to hear that.
Yeah, feel free to go ahead, Ali.
I've got a suggestion. I've got both the suggestion, and you never come with just a problem, right? You come with a problem and a solution. So both the suggestion and some potential help as well. I think the biggest changes in our industry are to the debt markets, right? And so maybe having someone chime in from the debt markets on what are the changes, what are the alternative sources of capital. I think the bridge to HUD I've been exploring as an alternative. I think Fannie and Freddie are just completely down right now with their inability to underwrite to future rent growth and constrained to just in-place rent. So, if you all agree, I think insight into debt markets might be a pretty good deal, and I'm happy to help put that on. And I came from the debt world. I was an underwriter for about a decade in various shops, including Freddie Mac. So happy to help however way I can.
That is quite fantastic. Thank you so much, Ali. I really appreciate that solutions oriented approach. So yeah, we'll definitely take you up on that offer. I think Tenny is taking notes. And
yes.
Yeah, I think Karen Anderson says pro forma analysis and deep dive into the investor slide deck. That's pretty cool. I think that's another one that we can certainly explore for sure. Yeah, and if for just like Karen, if there's any other person who needs to type in their suggestions, please feel free to type it right into the chat. We'll definitely take a note of it, and we'll be sure to bring some expert to provide that value to you all. Yeah, well, are there any other comments, questions, concerns, feedback? If there are not, I would be more than happy to give you some of your time back. Once again, I'm Dr. Julius, CEO of XSITE Capital. We want to say thank you to all of you that came to experience this meetup with us. We are here every first Monday of the month, except when there are public holidays, just like this month. And then we do it the second Monday of the month. But we're here every Monday of the month, every first Monday of the month to deliver this meetup to you. We bring industry experts to answer any questions that you may have. And sometimes we do lead the topics ourselves. We know you could be anywhere else in the world, but you're here with us today. We do not take that for granted. We appreciate you. We look forward to seeing you next month. Have a beautiful rest of your week, and let's continue to grow. Thank you, everybody. Appreciate it.
Thank you, everybody. Thank you for joining.
Thanks, everyone.
Oh, Lisa, we'll send it to you. Lisa wants to know how she's going to get a book. We'll send the packet to you. Braden will be sending emails and everything to everybody that won. So I think we have your email, and we'll definitely get that set up. Thank you, everybody. Bye.
Everybody.